Hi, welcome to Neppy Invests. I'm Neppy and I'll be leading this discussion today, as I do every single other day. Today, I'll be talking about AVA Risk Group and discussing whether it's still a buy. So I'll discuss that towards the end of the video. But first, I'll be trying to figure out why the share price has been increasing by quite a bit. I did a video on AVA Risk Group on September 3rd, a bit of a roarer video because I was still at the start of my YouTube video journey. So you can have a look at that. And since I did that video September 3rd, the share price has increased by over 100%. So the question is, why has it increased? Has there been any news? And if not, what's been driving it forward? So first of all, I'll just show you the chart. And this is a 3-month chart. So it's gone from, in 3 months, it's gone from 15 cents all the way up to 50 cents. So that's actually a 3-bagger or more. And that's a close of yesterday at 50 cents. So I did buy this company at 14.5 cents in April or May. But we didn't do much for a few months, so you've got to remain patient sometimes. And then on sometime in July, I forget exactly what day, we had the quarterly cash flow report come in, which was a very impressive quarterly cash flow. As if you've been following my videos, you know I really follow quarterly cash flow reports quite closely. And that was one of the most impressive ones I've seen for quite a while. And the market really liked that. You can see it increased price by quite a bit, and we had a lot of volume coming in. So a very bullish sentiment had built into the company with that announcement. We saw it base out for like a month or so. And then when I did my video on September 3rd, we had another big update. It wasn't any things significant released on that day. But then we've just seen this really good uptrend, a very sexy chart. You know, if you found charts sexy, this would be the sort of the definition of a sexy chart. It got to a share price of 50 cents at the close on the 12th of October. At this point, I would like to see the share price level off or come back a bit. That would be very healthy. We see that all the time with the share price moving forward here. You can see it happening a lot. When I did the September 3rd video, I did say it would come back to 26 cents or so, and it definitely did over the next few days before it started its uptrend again, because you just want these sellers, these nervous holders, to sell out because they may be blocking in profits, that sort of thing. On the bottom there, the volume part of the chart, I've just mentioned green bars are larger than the red bars, which indicates there's more buying on those up days than there are selling on those down days. That's actually quite bullish too. So overall, a very bullish chart. This is for AVA Risk Group. There's no point selling out. You might see some down days, but I think at this stage, 45 cents will probably be the down limit in the short term before it starts to go back up again. When I see a share price increasing like this, I'll just go back through the announcements, especially if I'm not following a company quite closely, and to see if there's been any announcements during that time period which could sort of justify why the share price has been increasing. So I've just taken this from ComSec, and it's you can see the market sensitive announcements. So those are sort of announcements that might drive the share price up by a fair bit or down by a fair bit. So the only market sensitive announcement in the past 2 months or since I did that video was the special dividend announcement on the 15th September. So we didn't see much of share price moving forward with that. And other than that, there's been nothing really suggesting why the share price has been increasing. There is another reason why it could be driving up. It could be just multiple expansion. So this is when the fundamentals of the business haven't changed. There's been no earnings growth. So typically, for an increase in value of a company, you need to see the earnings growth eventually come in. So that's the only way you can get to value increasing through time, is increasing in earnings, increasing in profits, increasing in cash flow. If we don't have that during a period, then the only way you can look at increasing share price is to be multiple expansion. And multiple expansion just means when you look at PE ratio, or what I've got there, EV over operating cash flow, those numbers have been going up. So the market is willing to buy at a higher price for a company, willing to buy in at the higher metrics just because they believe there's less risk moving forward and a greater potential for return. So the PA ratio has gone from 11.3 to 24.6. So back in September 3, I would even say with a share price of 23.5, which was a little bit higher than what I bought, it's still quite undervalued. With a market cap of 57, now with a market cap of 125 million, the PE ratio is 24.6. So even that number for a growth company, which AVA you could argue is a growth company, even that's not too much or too expensive, especially when you see some growth companies at 100 or so. So otherwise, one thing I would say is with no announcements driving the share price forward, it's just been this multiple expansion, and that's just benefited through positive sentiment. So I think what's been happening in the past 2 months is positive sentiments come in because of that announcement, the quarterly cash flow report, and we've just seen that positive sentiment just flow over the market generally, and we've just seen people willing to buy a little bit more for this company just because of that positive sentiment, if that makes sense. So another thing I do look for with share prices going forward is whether, say, fund managers or share advising platforms, whether they announce to their members whether a company is a buy or not. So I don't even know. So we could have a fund manager or a share advising group put out to the members that AVA Risk Group is a recommended buy, and that could drive the share price higher. Typically, what happens in those sort of situations is they would do the recommendation at, say, midday, and you'll see a really significant spike when you do the recommendation. I see this a lot. I've seen this like 2 or 3 times in the past month or so, where the share price just increases right on midday. It can increase 10 to 15% in a very short period of time. I think Nitro did this, Nitro NTO, and Mastra did this the other day. DTC, I believe. There was a recommendation at midday. Share price increased something like 20% in like a minute or so. So that's possible. Another thing is, possibility is, I look at Strawman Index every week. I think it was Friday or Saturday they release what they're doing with their Strawman Index. So if you don't know what Strawman is, just Google it. It's one of the most exciting community investment groups I know of, because what they do is they sort of had a portfolio, and that portfolio is made up of about 20 companies, I believe. And what drives the members of that portfolio is the consensus of the community. So if a lot of the community is pro a company, that would more likely see that company enter the Strawman Index. So that means AVA Risk Group entered the Strawman Index on the 2nd of October, which means it's becoming more and more loved within the community of Strawman. And once it becomes more and more loved, it enters the index. And we've seen if you follow the Strawman Index, you would be getting significantly higher returns than the overall market. In fact, their returns are quite impressive when you look at it. So I encourage people to go to Strawman and become a member. So you don't have to, there's no fees at all. I'm not even sure there is a fee. There is a fee option because I am a member and I don't pay fees. But you can make your own recommendations, write reports on companies. It's one of the best platforms I know of for sort of the regular investing community like you and me. So they recommended, or this AVA entered the Strawman Index on the 2nd of October at 39.5 cents. And we've seen the share price go up in the week and a bit since then. So that's a possibility. This could have been a possibility driving the share price forward. We might have people who really like Strawman and are buying because of that entering into the Strawman Index. So is AVA Risk Group a buy? And this is my take. I was asked this question when the share price was 34 cents, and all I said was depends. So that's a bit of a cop out, I suppose. But it depends. I'm not going to give advice of whether a company is a buy or a sell or a hold. It's all personal, I think. And my personal thinking of AVA Risk Group is I'm holding this. I'm not thinking of selling. I'm not even thinking of buying anymore. I'm just holding it for the long term because right at the bottom there, I let my winners run. But positive sentiment is very powerful. And when I did the video on September 3rd, it was definitely undervalued at that point. I can't say whether it's undervalued, overvalued, fairly valued right now. I don't do a DCF or anything like that to try to get a value of a company, because for a company like AVA Risk Group, I think DCFs are a fool's game, because you're trying to guess what the future cash flows are going to be over the next 5-10 years. I think that's ridiculous trying to guess that. And it's one of the reasons why people who did DCFs for A2 milk about 5 years ago just totally missed the story, completely completely screwed that one up because they completely underestimated the cash flows over the next 3 or 4 years that A2 milk had. Negative versus positive sentiment is very important here. Positive sentiment can drive a share price of a company way beyond its valuation. So even if you had a valuation of, say, 51 cents, positive sentiment can drive it to 70 cents, 100 cents, which is $1. You can't underestimate the power of positive sentiment. And likewise for negative sentiment can drive the share price down way below its fair value. And that's where value investors, find their companies they like to buy. So at the moment, just because it's become a 3.5 bagger for me, it's now become my second largest holding in my portfolio. So some people might think if it's become a large percentage of your portfolio, maybe you should take some profits off the table. So this comment I've just crossed out, always take profits, is something I don't like doing. I've followed that sort of rule I did use in the past, and when I look back at my biggest investing mistakes during the past 10 years, it's always been when I've taken profits way too early and not let my winners run. So if I look back at all the mistakes I've made, every single one of them has been taking profits and not letting my winners run. I can name a dozen cases where I've just gone for, share prices increased by 100% and I thought, oh, this is great, I'll just take some profits. And I've sold out of the company. I've just seen the share price keep going up and up and up. If the story doesn't change, there's no reason to take profits. Just let them run as long as possible. That's how you become wealthy in investing, and it's through compounding. And a good way to look at this is if you bought a company at, say, 10 cents and it goes to 20 cents, you've doubled your holdings. And if you don't sell out and then it goes to 40 cents, even though it's doubled from 20 cents, it's actually quadrupled for you. So that's how you compound your earnings or your investments. And the next slide I'm going to do is just a sort of a preview of my next video. And this video is about this always taking profits or letting your winners run. So I'm a big believer in let your winners run and don't take profits. Now, I'll explain a couple of instances in the past in this video of when I've taken profits to my benefit, but I'll always show you a few occasions where if I've just let my winners run, I would have been much better off if I didn't take profits on those companies that I did benefit from. So the best way to look at this is just to look at the difference between the maximum returns you can get from a company or a stock if you go long, not short, and then compare that to the maximum loss you can get from going long in a company. So what's the maximum returns you can get from a company? Is it 100%, 1,000%, or 10,000%? Well, technically, it's infinite. If you look at Fortescue Metals, Andrew Forrest, Twiggy, I don't know how low it was, but it was like 1 cent or something, and he'd never sold out of that company. He just kept on holding it, just kept going up. There would have been some holders who sold out for 100% and would have thought they were genius, and they would have been multi-millionaires by now if they hold out to now, potentially $10 million or so. So the maximum return you get from a company is infinite. It can keep going higher and higher and higher. What's the maximum loss you can get from a company or a stock? Is it infinite? Well, no, it's not. Is it 10%? 10,000%? No. 1,000%? No. The maximum loss you can get from a stock is 100%. 100%. That's it. So if you let your winners run, you can get 10,000% or so higher. But if you're always taking profits, you're minimizing your upside. That's the problem with always taking profits. You're minimizing your upside. If you always take profits at 30%, I've seen this, people say this all the time. Oh, you should take profits at 30%, lock in your profits. You're minimizing your upside. You're not getting that maximum returns you can get. And when you compare that to the maximum loss, in fact, your maximum loss percentage could be 100%. So your maximum loss is going to be greater than your maximum gain if you're always taking profits. So that's the reason why I'm a big disbeliever in always taking profits, and I'm a massive believer in let your winners run. That's how you build wealth in the long term. That's all for today. I'll talk to you later. So, look, I'm not going to say whether a company's a buy, sell, or hold. I'll just tell you what I'm doing. But it could be a buy if that's your strategy. It could be a sell if that's your strategy, blah, blah, blah. But I'm not a professional advisor, and that's the main reason I'm not going to say whether a company's a buy or not, because if you take my advice and I'm not a professional advisor, that's pretty bad. If you do need professional advice, make sure you seek out a professional. So that's all for today's video. Hope you enjoyed it. And in tomorrow's video, I'll be discussing let your winners run compared to always taking profits. Hope you joined me for that one. I'll just leave a link to, there it is, leave a link to my previous AVA Risk Group. Don't judge me on that. It's one of my earliest videos and much more rawer sort of video. But I did go into the company about what they do in that video. So if you do want to know what they do, just look at that video. Otherwise, have a good day, and I'll speak to you tomorrow. See ya.